What are you paying attention to thematically, oil and gas or energy broadly going into 2025?
The crystal ball gets a little bit murky because there are a lot of external events, geopolitical things, OPEC things that make it tougher. Things could go south here on the macro from an oil perspective pretty quickly. I don't think they will, importantly, but they could. People are scared of oil. They're excited about gas.
Elections, do they really matter? Maybe, kind of, maybe not.
Trump, I think, is a lot of noise, but I don't know that it's a lot of impact.
The energy transition and where you see things going from an investment standpoint here in the next, 2 to 5 years.
It was a frenzy. It was a sentiment frenzy and a spending frenzy, public market frenzy. And guess what? That frenzy popped. You lost 20% in the ICLN Clean Energy ETF. The realization of the returns weren't very good, right? BP's the classic example. They went hard at this. They bought in, they spent up, paid up. Returns weren't very good. They were a massively underperforming stock. And they said, ooh, we're going too hard, too fast. Backed off. The whole world's backed off a little bit in terms of the pace at which they think net zero can happen.
Dan, welcome to the podcast. Thanks for coming back on.
Glad to be here. It's been a while.
It has been a while. I'm not going to do a bunch of your background. If people don't know Dan Pickering, go look him up. He's got an illustrative career as an entrepreneur, a guru on the energy market space, oil and gas, the energy transition. His company does investing, a lot of great research, all kinds of awesome things. And so I'm excited to have you back on. And I think I'll just kind of let you open riff at the beginning here around just what are you paying attention to thematically, oil and gas or energy broadly going into 2025? What has you interested? What are you interested in and what your company's paying attention to?
Sure. And after that very kind intro, it may be all downhill from here. Hopefully I can live up to that. But what are we thinking about for 2025? Very relevant question. Every year for the last 10 plus, I've gone out to Midland and done a forecast lunch and talked to the folks in the Permian Basin about how we see 2020, next year, 2025 shaping up. Did that a couple of weeks ago, and so it's very timely. It's a murkier outlook right now than it was, this time last year, this time, looking into 23. Why? Because I think we've got a commodity market on the oil side for sure that is balanced at best, maybe skewed to slightly oversupplied. You've got OPEC that says they want to come back, so we really have no space for them. And so you wind up saying, wow, things could go south here on the macro from an oil perspective pretty quickly. I don't think they will, importantly, but they could. So it's kind of the crystal ball gets a little bit murky because there are a lot of external events, geopolitical things, OPEC things that make it tougher. Flip to the gas side and it feels better. The markets, I'm saying the consensus essentially for both oil and gas, people are scared of oil. They're excited about gas. I think directionally that's probably the right trend to be. And then the other question as an investor is what is going to change that makes people care about our sector again? Coming out of COVID, we were off, right? It was awful. The oil price went negative briefly, as we all know. And then, energy in 21 and 22 is the best group in the market. 23 lagged by 2,600 basis points. 24 were lagging by 1,500 basis points, something like that. And as I stare into 2025, wow, we have a murky outlook for oil, tech's still running, the market's making new highs, energy stocks kind of aren't. Where's the money flow come from? And so we have really cheap stocks, high free cash yields, great discipline, but a kind of a scary outlook a little bit. And so, maybe it's more of the same where the companies are doing really well and they just continue to trade cheap. So those are some of the things that I'm thinking about big picture wise as we go into 25.
It kind of feels bearish. It's hard to put your finger on the exact reason. I mean, some of the things that you've mentioned, OPEC obviously is a big question mark, but what we're seeing out of China is a little freaky. You know, they got a bunch of this kind of record stimulus plans coming up, and they still had a bunch of issues. You know, just demand in general. I think pretty sure I saw a report that OPEC's kind of continually revising down what they think for demand, and it's one of those deals too where I know they say elections. I've heard you talk about it on mainstream media and on podcasts and things, but do they really matter? Maybe, kind of, maybe not. But it still feels like Trump clearly wants prices to be lower. So there's just kind of an eerie feeling. And then also too, if you look back at like the last 10 years, taking out the whipsaw of COVID and then the rebound, it was like 55 is kind of the average, or 50-ish. And then if you add in those times, maybe it's in the 60s. It's like, is that the new floor? Do we range bound higher? Do we kind of regress back down to where we were from 2014 to 2020? There's just a lot of production out there, especially considering what OPEC's doing. And I don't know. I'm wondering, is there going to be like a Trump surprise? Is he going to try to strike a deal? And would OPEC even care? Do they care about market share anymore? Just broadly, maybe the psychology of the new Trump administration combined with what do you think OPEC may be doing here in the coming year?
Yeah, and before I do that, let me respond to one of the things you said. It does feel a little bit eerie. If we looked at the last 18 months in the crude market, particularly as it related to geopolitical events, you'd see something happening in the Middle East and oil wouldn't really respond. And you'd say, oh, the market's so dumb. It doesn't understand the risks of what's going on. The day that stuck out to me was, or the week that stuck out to me was, China made one of their first rounds of stimulus. Iran and Israel were swapping bombs, and oil rallied all the way to 73. So that's like, wow, this is a heavy market. And you look, and the oil market's been right. It didn't worry about all of these geopolitical things because it said, the only conclusion that we can draw from the market was that there weren't going to be enough physical supply disruptions to truly matter in terms of impacting price. And so the market's been pretty good over the last year. And now as we look ahead, you got a lot of bearishness, pretty big short position or, relative to history in Brent. Trump and OPEC was your question. So OPEC plus, they're probably praying that Trump does something with Iran sanctions so that they can come in and offset the barrels. And one of the things that's been rolling around in my mind as an observer of the market is right now we have OPEC plus has done, a yeoman's job. They probably have 3 million barrels a day of 3+ million barrels a day of oil off. They want to come back, but they haven't. They're kicking the can down the road. Let's say Iran gets sanctioned and they turn on some barrels to help offset. Price probably doesn't go a lot higher, right? But then what happens is the guy who's saying drill, baby, drill, and I want really cheap crude now controls Iran's barrels, if you will, via these sanctions. And so, do you want a Trump overhang or an OPEC overhang? OPEC overhang might be better. So I think this year, I think they're in a box, OPEC. They're in a box because if they come back, oil goes to 50 or 45 or something like that. Why? Because there's not an inch of room for them. So you're going to have to push some barrels out, and $68 isn't going to do it. $65 isn't going to do it. $60 isn't going to do it. We've seen that in the last decade. It takes pretty low prices. So they can't come back unless price goes lower. They need, if you just look at Saudi, to be revenue neutral for Saudi, if they went from 9 to 10, let's do the math. They produce 9 million barrels a day now, sell it at 70. They get $630 million a day of revenue. If they go from 9 to 10, well, what do they need? They need, to get 630 million. Yeah, so they need 63 to be neutral. They go from 9 to 11, they need 57 to be neutral on a revenue basis. I think if they add 10 barrels a day. I'm joking, but if they add any production, oil's going a lot lower than those two numbers. So they're going to lose revenues. Can they handle that? They meaning OPEC, Saudi, et cetera. Feels like near term they can't. The problem with the box they're in is we may be in this situation where it's tough for them to come back for 2 or 3 years. So, so at some point they may give up and just go, screw it. We have to inflict some pain, back people off again, just like they did in 2014. I don't think that's going to be in 2025, Max, but it's hard to predict. So I'm running 65.75 this year, which I think is probably well above consensus expectations, and that's because I don't think OPEC will come back. And then, as it relates to Trump, the guy's a wild card for sure. I don't think he's going to get drill baby drill out of the industry because they wouldn't do it with Biden at 120. Why are they going to do it with Trump when oil's 70 and the market's arguably looser? So I don't know what carrot you could use to get people to come back. I don't know what stick you're going to use because any stick just makes the situation worse. So, so I don't necessarily think Trump has a meaningful impact on the behavior of the U.S. industry. He could influence geopolitical stuff. The other one we didn't talk about was if he solves Russia-Ukraine, then my guess is oil goes a bit lower just because there's going to be a knee-jerk reaction that, oh, well, Russian barrels are going to be, easier to access the market. So Trump, I think, is a lot of noise,
Yeah.
but I don't know that it's a lot of impact other than the geopolitical stuff. You boil it all down, and I think Trump is, very visible and a lot of noise. He's not even in office yet. I don't think he's going to influence the industry. He might influence the geopolitical stuff, which by definition makes it just harder to forecast and harder to figure out. So there's a bit of wait and see we're going to have to do. Let's get the energy secretary in there. Let's get him in there. What happens to tariffs? Let's get a month or two in the office and see if energy actually still matters to the administration.
Right. Yeah. I mean, what's interesting about what you talked about was OPEC and Saudi Arabia specifically being kind of boxed into a corner. And for a long time, it felt like the supply share push that they were doing was going to crush shale oil. And then, for a while, you thought maybe it worked. And then now it seems like, US production has been so strong. They're kind of at this rock and a hard place moment. I mean, like you said, do they go back to this whole, hey, we got to, flood the market to kind of try to claw some of that back and clip the wings a little bit of the US shale? But I don't know that that strategy is going to work either. And everybody, clamors on Twitter and online. Well, they have to have these higher prices to meet their budget goals. But man, they're just in kind of a tough spot as to what they actually do here. And I love talking about this because no one really knows, but it's interesting. It seems to have evolved a lot over the last couple of years.
A lot of game theory here because in 2014, shale was vulnerable. Been a huge ramp in growth, tons of debt on the industry, cost structures had moved up. Today, if you look at shale, balance sheets are in great shape. There's more activity in lower cost basins, meaning like the Permian's a bigger component of supply growth and overall supply than it was as we were ramping through the shale boom. And so I don't know that OPEC's, if they took some punitive actions, I don't even know if shale would be the target. The target might just be supply in general.
Mm.
And, but again, the box is Guyana, the money's spent, or the project is, sort of moving downhill in terms of momentum, and isn't going to stop. The Brazilians, I mean, maybe they'd back off on some of their supply adds, but the next couple years is kind of the supply side's set, and so it's a long game there. So the game theory is, well, I don't know that I can influence some of the more meaningful players in the near term. Therefore, should I try to influence them? How much do I hurt myself versus hurt them? And I mean, the one thing we know is they're their reserve life is longer than anybody else, and their dependence on hydrocarbons is really important. So they can make 10-year moves where right now I would say, U.S. public companies make 1-year moves. But, you know, I'm just, I do hang on every word, in their press releases. What are they going to start signaling?
Yeah. I don't have as scientific of a view. I mean, our company does a lot of research. I pay attention to people like you. My gut just makes me feel a little bearish, like it could be a little lower than what people are thinking. So we'll see where it goes. It just feels like, again, Trump makes a lot of noise, but he's clearly focused on trying to get it lower. So we'll just see. But I want to pivot to gas. And just your thoughts around, I mean, obviously you said it's more optimistic going into 25, 26, 27. You've got all this LNG coming online, some of which getting shifted around a little bit, but still large chunks of LNG coming on. Does it meet expectations, and can we be range bound for gas at a higher, call it, floor than we've been? Or does this just tsunami of new production from the likes of all these giant gas drillers overwhelm it quicker than people think it will, like it seems to always do when we get these kind of bullish demand pull things going on?
Well, this is one area where, right, the new administration is going to certainly be helpful. We think. You just heard Trump say, spend $1 billion in the U.S. and we'll be accommodative with permits and processes, et cetera. So you figure the LNG side of the equation is going to have a smoother path forward than it has under the Biden administration. So qualitative tailwind there. Um, the industry showed us in the last year they will turn things off if there's lower prices. The futures curve says we're going to have a higher price. We kind of turn on 10 BCF a day, give or take, of LNG between now and 2030. I think on the demand side, there was a ton of excitement about data centers. I I tend to think that's a little bit overdone. It'll be incremental, but it's not. If LNG is 10 BCF a day, data centers are 1.5 or 2, in that same time frame. So from my perspective, you got a lot of positives on the demand side. There's plenty of gas supply, um, but $3, 3.50 gas, which is much better than we've seen, is it's not Herculean. It's not going to turn on. It's not going to take rig count up 50%. So I think on the gas side, the other piece that we have, again, qualitatively, is the world's figured out we're going to need it. For a while, all hydrocarbons are bad. We got to,
Hmm.
we got to kill them. Decarbonization efforts are slowing down, which means on the electric side, we need more gas. Um, and so it's the best. It's the best hydrocarbon, and hydrocarbons aren't going away. So that to me feels like another qualitative tailwind. Um, and then you have to decide how much the market's already baked in. From a commodity perspective, you got to watch winter too. I can't predict OPEC. I certainly can't predict weather. But a $3 to $4 gas price range to me doesn't feel unrealistic, and that'll be better than we've had. So, how much of that's priced into gassy energy stocks we could debate, but um, I'm if I allocate my bucket of worry, it's 2/3 oil, 1/3 gas. If I'm thinking about things that scare me.
Well, and certainly a lower oil price could be bullish for gas. You've just got so much associated gas. And so if, production slowed down in the Permian or in any of these other oilier basins, it makes up some of that wedge. I think the dry gas guys could easily overcome it. But in the short term, if oil did have a pullback and, new activity slowed, maybe that does even support that higher floor for gas coming up here at the end of next year and into 2026. I wonder too, how much of I know everybody is seeing how much gas supplies we have, the trends in the energy transition and decarbonization, which we'll get to later, is making people shift and look at gas more. But like, where do and we talk about this and pontificated internally, but is there any view on saturation globally for LNG? Like we just act like we're like, yeah, we'll add another 10 BCF, then we'll add even, we got all these permits. It's like, at what point does it do we start seeing gas on gas composition, tankers sitting waiting because it's not, we don't need it? I mean, I just wonder if you guys think about that at all.
I absolutely do. Um, Give me a little leeway here. When I think about cycles, you go from you're always in the process of going from not enough to too much and back again. You're somewhere along that continuum. And if we think about the price spike associated with the Russia-Ukraine war and the cutting off of supplies of gas from Russia to Europe, and the that massive spike in price kicked off a lot of stuff. It kicked off, oh wow, we really need more LNG exports globally. Russia, we're going to punish them. It would make sense just from a cyclical perspective that we're going to have too much LNG because we had this period of high prices and fear that we didn't have enough. And now it's like, oh, Europe is going to have to completely win themselves off of Russian gas. So somewhere out there is the impact of all the we've got to do more sentiment, spending, new projects. And remember, it's not just all LNG. There's pipeline projects that can bring, gas from the Med, et cetera. And so I look at that and say it absolutely makes sense that we're going to have an LNG glut at some point in time. Is it this decade? Probably not. I mean, I kind of think I start thinking 2030, 2031, 2032. Somewhere out there, we'll have too much. And one of the things that will be a key indicator is going to be if Russia and Ukraine resolves, then how much gas does Europe actually wind up turning off or turning away versus actually saying, well, okay, we can't have 50% of our gas supplies from Russia, but we could have 15. If that's 5 BCF a day, guess what? You just lost 5 BCF a day of LNG demand too. So I think we'll probably have some sort of negative surprise at some point around that Russia-Europe relationship and the impact of all the new projects. And so somewhere out there is a damn, I wish we had less supply moment. But I don't think I think there's a window where things can be pretty good for everybody in the gas business. I mean, 3-4 year window, 2-3 year window, 3-4 year.
That's interesting. Now, I've kind of heard similar sentiments from some smarter folks than me that pay attention to this stuff. It's hard to know exactly, but I think the Russia piece is a big one. Back here domestically, another thought that I've had, and I should probably have a better sense of this given my midstream background, but I hear these huge numbers, 6 BCF, 10 total, and I know intuitively gas pipelines that carry that much gas, it's a lot of infrastructure. It's almost like I just haven't seen as many stories and headlines about this. Maybe I'm not looking in the right places, but you look at this very short time window when there's like 5 Bs or 6 Bs coming on over the span of 12 months. And I'm like, that's a lot of pipeline capacities. And some of these major infrastructure backbone pipes are running at 90% utilization during peak times. Are you guys watching that at all? Maybe opportunities to invest, intrastate headers, just things that I've heard some rumblings of those projects, but intuitively, like that's a lot of gas coming to a pretty small geographical area. Are we set up to, I'm assuming we're set up to service it. I just don't hear about this narrative enough.
Yeah, it's a great point. And I think that one of the interesting things that's now developing, if you think about gas supply in general, you've got projects that are essentially west of Houston, and you've got projects that are east of Houston.
Mm-hmm.
And there's not a great way to get gas around Houston. So like all this Permian gas can't get over to a number of the LNG projects on the east side of Houston, the Louisiana type projects. And so basis is something that we think about a lot. And as these projects start to turn on, are you going to wind up with bottleneck gas in certain places and high prices on some hubs and lower prices on others? And so it's, again, pretty complex problem. I think I think the LNG guys have, for the most part, got enough capacity to get gas where it needs to go. There's still some stuff that has to be built. The Trump administration should help that for some of the 27, 28 projects, some connector lines, et cetera. But I think just like today, we see negative gas price out in the Permian because gas is trapped out there. We may be moving trapped gas issues around over the next 2 or 3 years as these various facilities turn on and as guys are trying to move stuff around.
Yeah, no, that's interesting. It seems like the basis traders and the regional traders could have a fun time with all this. The guys that get real smart on it, they tend to figure out those arbitrages before anybody else. What about, do you guys pay attention to storage at all? I've heard a lot of rumblings around the need for more storage, but then you'll talk to some others and they'll say we got tons of storage. It's in the ground, and these EMPs can turn it on and turn it off. But just wondering if you guys are looking at that space at all and
Yeah,
seeing anything there.
we
That's
think about
interesting.
it a lot. On the investing side, we've got a relatively small investment in a new storage facility. If you think about the absolute magnitude, I talked to someone the other day that put it really well. He said, we have a market that 20 years ago produced 70 BCF, and today it produces 100 and change. And our storage is about the same as it was. It was about four TCF then. It's about 4 TCF now. So I think you're going to see more vol, and by definition, storage.
Mm,
Yes, turning wells on is quick. Storage is quicker than turning wells on. So I think that there's going to be a lot of value
yeah.
around that volatility. So storage makes sense to me, and there hasn't been a lot of capacity added there. So it's an interesting area, I think, for us.
Well, that's good on the gas side. We could talk more. There's a bunch of interesting topics there, but wanted to switch over to the energy transition and the decarbonization stuff, the ESG stuff. A couple years ago, call it 2020, 2021, it was just a foregone conclusion that there was going to be this overwhelming transformation. And in a lot of ways, there's been a number of things that have changed, a ton of investment going in. But I have noticed just through a lot of different indicators that has slowed, in my opinion. I want to get your take on it. And I've, talking to, got a lot of connections in the private equity space. They are saying things, guys that were seemingly pivoted 100% to that stuff 2, 3 years ago are now saying it's kind of the demand for dollars flowing there has been a lot lower, and they're pivoting to something else now, either back to traditional energy, or they're looking at tech, or they're doing other things. Just wondering, as somebody who is actively investing and you care a lot about finding good opportunities and good returns, as well as somebody that's talking, I'm assuming, to the LP or institutional space around what they care about. Just your thoughts on like kind of the state of the energy transition and where you see things going from an investment standpoint here in the next 2 to 5 years, given where we're at today.
Still a huge issue. We're spending more money in 2024. We spent more money on energy transition from a capital perspective than we did from oil and gas. And the energy transition,
Interesting.
it was a frenzy. It was a sentiment frenzy and a spending frenzy and a public market frenzy. And guess what? That frenzy popped, and you lost 20% in the ICLN Clean Energy ETF last year. You lost 20% this year. The public market's decimated in arguably what is one of, I mean, I think AI is now the biggest theme, but decarbonization is still a huge multi-decade theme. So I think there's still a ton of momentum around decarbonization. Uh, it's just kind of lost its momentum in terms of from an investor perspective. But I still think the dollars are going up. So if we think about oil and gas capex being pretty flat, capital discipline, I think that trillion plus dollars we spent in energy transition in 24 is still going to 2 and then 3 trillion a year. It's just happening a little bit differently. Private equity raised a bunch of money. They're deploying that capital. they're doing wind projects and RNG project or renewable natural gas projects and um, trying to develop carbon capture projects. I mean, one thing to think about is all of this is infrastructure and they're billion-dollar things. I mean, you don't do a small energy transition project. Most of them cost, a gazillion dollars. So governments are still spending. Ours may be pulling back the subsidies, but overall, I think government's still spending a lot of money. Probably not at great returns. They're spending slower though. That's the other thing is the pace at which everyone thought this would accelerate is not coming true because lots of inefficiencies and the realization of the returns weren't very good, right? BP's the classic example. They went hard at this. They bought in, they spent up, paid up. Returns weren't very good. They were a massively underperforming stock. And they said, ooh, we're going too hard, too fast. Backed off. The whole world's backed off a little bit in terms of the pace at which they think net zero can happen and the spending pace, the ramp, year over year ramp. So I think the energy transition mindset has gotten much more realistic. On the margin, projects are moving slower, but you feel like they have a better chance of generating profitability. If you step into the private equity world,
Hmm.
ton of capital raised, that's slowing down. The LP universe has gotten allocated. They don't need a ton more allocation given the slowing kind of nature of the business. And the GP universe, the sponsors, the private equity companies, um, they are they are becoming more balanced in what they're doing again as well. So what I would say is energy transition is still up and to the right. The angle of that line has slowed. Is slowing. We're going to spend lots more money on it, but at a slower pace. Uh, Private equity, both allocators and the companies themselves, have slowed down to what feels like a more reasonable level, and returns are moving higher. So all in all, the only bad thing about that is decarbonization is happening slower. The financial elements, I think, are improving. The timing elements are getting worse. And so if you are a decarbonize at all cost person, you're disappointed. If you are a decarbonize
Hmm.
profitably person, you're happier. And I'm in the latter camp. And so I think this makes more sense to me.
Well, there's some projects that still, it depends on how you put the spin on it. And, back in 2020, we were looking at infrastructure projects. We'd raised some capital. We really liked this electric compression company and pushed really hard to get a deal done to acquire this company and scale it. And our sponsor pushed back. And I think it was more LP driven, saying, well, that's helping pump oil out of the ground. Is that really decarbonization? Our argument was that it was, because it was way cleaner and they weren't, putting methane into the air like a normal wellhead compressor when it blows down. And they ended up recapping. And then, yeah, they ended up, we didn't get the deal because the money kind of didn't want to do it. Another company came in and recapped them, and then they just exited it. I think they got in at about 150 million, and they exited at 980 this year. So very good, 4x or more return. I don't know how much debt and equity, what the mix was, but they did very well, and I think they've reduced a ton of emissions. Say that again.
I said, you didn't pay up enough, obviously.
I know. The frustrating thing is, without getting into the total weeds, I think we had the bid, but it was tough. I mean, like, it was just tough to satisfy these parameters that were placed around the investment universe. It was like, hey, we think this is a good story. It makes money. It's also greener, however you want to define that. But more importantly, it made money, and it also did those things. And so I'm just wondering, what other kind of winners and losers around the space do you see? Things that are still actionable, things that are still interesting, given that returns have suffered where some of the dollars have gone.
I think we still see, so we're seeing better risk reward in, wind and solar projects. They got bid down to what I would say is ridiculous, or very high valuations or ridiculous returns. Um, and I think that's
Yeah.
improving. some of these renewable fuels projects. I think again with the current subsidies in place, makes sense. Carbon capture is going a lot slower. You know, um, we had a situation where I think people viewed producers of carbon, the emitters, as being willing to pay to get rid of carbon, and they figured out maybe they can get paid to remove carbon. And so that difference in expectations, I think, has slowed projects in carbon capture. Um, I think they'll go ahead. The one of the big areas that I think has really fallen off has been, what I would call, you know, very deep tech, stuff where folks aren't trying to raise a lot of money, but the probability of success is pretty low. The true venture stuff has really slowed. Um, but the what I would call the bread and butter renewables businesses have, I think they've gotten more attractive because you sort of know what you're doing. You're not taking a huge
Hmm.
amount of new technology risk. It was really just what the competitive dynamic was bidding down the returns to. I think we're back to double digit returns in renewable projects. The one other area that has gotten a ton of attention, and it's sort of energy transition adjacent, if you will, is just the whole power business and the dynamic of how to make the grid better, and whether that's grid resiliency, um, new generation, clean generation. Nukes had a renaissance. Max, the thing that's really fascinating is that if you looked at, so this data center dynamic has accelerated and really brought a lot of attention to some issues that we might have talked about on our podcast 3 or 4 years ago. We probably did talk about nuclear, and the problem with nuclear 3 years ago is that it was going to take a long time. That's still the problem, but now people are saying, wait a second, this is worth doing because I need clean power for a data center. So the sexy tech guys, Meta and Google and Microsoft and those folks, Amazon, um, they may be helping fix a problem that people have been waving about for a while. But now that the cool kids care about it, are interested in it, and are driving it, we may get more capital, we may get more stuff. So, nuclear is also an interesting area that still feels a little bit like, still feels very hard to invest in from a private equity perspective, but from a broad perspective, that's pretty interesting too.
Yeah, I was gonna touch on it a little bit. I'm glad you took it there. It just seems like maybe this is its time. Prior to the AI data centers, it was a lot of folks clamoring for it or a lot of wishful thinking. But like you mentioned, now that you've got some serious players and these mega cap tech companies that seem to want to go that direction, it's adding more legitimacy there. And look, like you said, if even if it's a longer time frame, if it gets them to where they want to be, which is massive amounts of virtually carbon free energy, that may they be worth taking that longer investment time frame. And maybe it's now perceivably less risky if you've got these super blue chip you know basically anchor tenants that want to use it. And if there was and also you think too around the government, I mean, I getting on board. I mean, I thought like with the Inflation Reduction Act, which is really the Green New Deal light, had they allocated more towards nuclear versus some of the other dollar buckets that they put in, they probably could have made a pretty big push there. But it really wasn't, high on the agenda with that. So if there's a will, there's definitely a way. I mean, I wonder how, if it is an overblown narrative or is it actually has the tide really turned and is it really shifted that direction? I kind of tend to think that it has. Just I think enough people have woken up to being like, hey, this is something that long term it has to happen. But we'll see if it really plays out.
I think the put a pin in this one, right? But so I think the tide has turned. I think we will see a lot. 10 years from now, there'll be a lot more new online. Whether or not I want to go out and buy the stocks of the nuclear companies that are up 3x in the last 4 months, probably don't want to do that. That's a little overhyped to
Hmm.
me. feels a little, memey to me, if that makes any sense. So um, I think
Yeah,
that's telling you it's the real deal. We're going to have a choppy path to get there.
for sure. No, that's good. Shifting a little bit to Pickering Energy Partners, just what's you guys are doing a bunch of different investment. You're doing great research. Just what's, I mean, we talked about some of the themes you're paying attention to, but what excites you in the traditional, we'll go traditional energy, oil and gas space? I've heard a lot of interesting themes. We're close to private equity, and a lot of people the activity seems to be kind of picking back up. You see things like going back in and recompleting old areas that maybe had old fracks on them. You see things like people shifting outside of just the Permian. You're seeing some pretty big M&A activity going on in the Uinta, the Mid-Con, Eagle Ford's picking up. Just wondering, as you guys look at the traditional energy, oil and gas landscape, do you feel like it's a target-rich environment and there's a good opportunity right now to put dollars to work and make a good return?
Yeah, great question. We're on the private side of conventional energy. We're deploying capital in a couple strategies. One is doing non-operated drilling projects. So, we'll come in and we'll participate in an AFE to drill a well alongside Conoco or Oxy or other folks, uh, and and then we also are participating in existing production, which is more of a yield oriented thing, right? So we're out there trying to invest in oil and gas and make 12, 13, 14%, and then we're trying to make 25 to 30% by taking more risk and drilling wells. It's a great time to deploy capital from my perspective because there is a lot going on. We're not a 5 million barrel a day producer in the US or a 70 BCF a day producer. We're 105 BCF a day and we're 13 million barrels a day. There's just more happening. And when there's more happening, it's with the big
Hmm.
guys and the middle guys and the small guys and the tiny guys. And so, by definition, at all parts of that food chain, one of the things we've seen is that um, lev- areas of risk gotten very bifurcated. There's money to be deployed on infrastructure projects at single digit returns. There's money to be deployed for cash flowing barrels at low double digit returns. You just go up the ladder. There's debt, there's equity, there's a continuum of capital out there because there's a continuum of opportunities. And so with sentiment where it's at, with oil price where it's at, you've got pretty inexpensive opportunities. I look at the publics are buying each other because they can do it at 3 or 4 times cash flow. I want to put money to work at
Yeah.
3 or 4 times cash flow. So the public stocks look interesting without a catalyst. The private stuff looks interesting with a cash flow element that gets you paid over time. And so it's a really good time period to deploy capital. The other thing that's happened is that the strategics are buying each other. The big oil and gas guys are buying each other. The publics are buying each other. The amount of capital available on the private side of the equation shrunk by 2/3. The big funds have gotten smaller, the little funds have gone
Hmm.
away. And so when supply of capital goes down, returns on capital ought to be going up. And I feel like they are. So we're very bullish on deploying capital, even though I just told you 25 feels risky and the public markets may not care about these stocks. Um, that doesn't make them uninteresting. You're just asking yourself, when am I going to really get paid for this? So it, we like putting money to work here. Um, I I do wonder when on the public side the market's going to care more, and if I've got a company with a good balance sheet that's returning some capital to me in the meantime, do I care? Okay, is it 26 or 25 or 27?
Hmm.
I make 7 or 8%, or my company's throwing off 12 or 15% free cash yields, then okay, I'll wait. So, pretty good time to put money to work, I think.
Yeah, I tend to agree. I think it's a really interesting time, and I like what you mentioned about the private available capital shrinking. we've noticed that over the last couple of years. And I going into 23 and 24, I kept remember thinking, man, if you have money right now to go get after it, you could be, it could be a lot of opportunity versus, but at the time there was just a lot of folks that just didn't, the private equity had slowed, the fundraising had slowed. And so you didn't see, I mean, I think when we started our company in 2014, we used to joke, it was like every week, it seemed like a new private equity team, E&P team was getting backed. And that was great for us because that was our primary clients. And, then in 2020, it was like no teams or one team or something got backed, even though that was actually probably a pretty good time to do it, but the world was freaked out. 2022, 2021, not many teams. Now you're still not seeing as many teams, but there are more. And you're seeing legacy teams with the track record get re-upped or get allocated dollars. But if you have the capital to spend, it seems like, or the availability to now seems like a good time. And the next question is like, if you think about the Permian as tier one, how do you rank or view these other basins? We'll start with oil. I mean, gas is its own thing, but where is interesting opportunity to you outside of the Permian?
Yeah. So I guess what I'd say is that the answer has to be a function of how much capital you're trying to deploy. Um, because,
Interesting.
you know, it's at 6 million barrels a day, almost half of total U.S. production. There's just more going on in the Permian than anywhere else with pretty attractive assets, which means they're relatively more expensive, right? The Permian's kind of like the best place to do business. It's the best restaurant in town, and you pay up when you go there. If I think about other
Mm-hmm.
areas, if you're trying to deploy small dollars, gas, oil, the Bakken, the oily Utica, there's ways, you want to get in there and grind around and really put in the sweat equity. There are opportunities all over the place in all of these basins. Um, from a pure size perspective, I think the thing I think about is where have we seen consolidation and what's going to fall out of those companies and non-core assets. So Permian, obviously, seen a fair amount of consolidation in the Bakken. So I think you could see some there. You're pretty fragmented still in the Eagle so less, probably still more public competition, if you will. The Haynesville is really interesting to me because it's close to these export markets. It's a higher cost basin, but it's also a lower basis differential basis and basin. And so the Haynesville's interesting. Appalachia's still got the issues of pipeline takeaway. Again, can you scratch and claw and find things there? Yes, you can. And so, the Rockies basins have had some opportunities. So, the answer is pick your risk profile, pick your size profile. And, another area that there is a lot more activity has been offshore. You've seen a number of new players deploying capital out in deep water, non-operated, of course. Now, those are bigger checks. You got to bring $100 million plus, $200, $300, $400 million plus into those processes. But the economics in offshore are great. Still feels, it's the evolution of what's going to happen. I think is that as shale matures in the U.S., folks are going to go back and look at conventional things, not shaly stuff, but drilling salt domes and stratigraphic traps. And they're going to think about more international, whether it's Canada, Latin America, et cetera. Plenty of time to focus on that. I think it's still a tiny bit early, still lots to do in North America.
Yeah, it sounds like the theme there is there's plenty to do. Plenty to do, which is exciting as somebody who's, I guess, relatively young at this point, not as young as I used to be. But in the industry, it's like there's just still seems like there's a lot of opportunity. And I think one of the mistakes we made when trying to deploy infrastructure capital is not. I think a mistake a lot of people make is not just focusing more on the Permian. You always think, oh, the Permian's so competitive, it's so expensive, it's so hard to get in, but like the sheer magnitude of activity there there's just always something to do. Almost, it seems like if you overlook it, it's just I tell people all the time. They're like, "Hey, I got this commitment. I'm going to do a midstream thing. What do you think about this? What do you think about that?" And I'm like, just start at the Permian. Like, exhaust everything that you can in the Permian, and then if really nothing's shaken out, then pay attention to these other areas. But there's just so much going on there, and then to your point, outside of it, there's still a ton of interesting stuff. So there's a lot of opportunity.
When you a movie that I like is The Perfect Storm. It's got George Clooney and Mark Wahlberg in it, and
Hmm.
these guys are out on their fishing boat looking for swordfish, and they're having a tough time, and they set sail for a new spot. And the crew says, "Why are we going there?" And George Clooney says, "Because that's where the fish are." I mean, the Permian is kind of like that. That's where the fish are.
Yeah, absolutely. Well, here are the last 10 minutes, just incredible entrepreneurial track record. And it's hard to do. I mean, it's hard to, I think once you get in and you've had the amount of established success that you've been able to do at your different various pursuits, it gets maybe a little easier. You kind of get that momentum. But what was that first light bulb moment that came on for you when you said, "Hey, we're going to go try to build something," and then walk through for people that don't know a few of the ventures that you've done, some of the things you've learned, and why you clearly seem to be passionate about it?
Yeah, I mean, boy, 10 minutes. Uh,
I mean, we could have done the whole episode on this. I like talking
well,
about it, but
I'm joking a little bit. Here's the thing. Um, you follow what you like to do. And, I mean, you really have to be honest with yourself. So I I went to be a petroleum engineer because I was good at math and science, and petroleum engineers make a lot of money. And I'm like, I'd like to make a lot of money, and
yeah.
math is great. This is what I'm going to try. And um, and then after out of undergrad, I went to work for a big company, and I didn't love it, and I frankly didn't love being an engineer. And so, and ironically, so I went to work at Arco. I got there in 1988 and left in 92, and there were two reduction in force in that 4 year period. And
Mm,
so, as the 23-year-old guy at the time, I said, "Man, by the time I'm 40, I'm going to get fired. Doesn't matter how good I am. It's just that's the way this business works." And so I said, "I got to go do something else. I got to figure something else that I'm more excited about." Um, and so I loved the stock market, and I got a job in it. That was amazing. Really enjoyed that, and have been focused around the markets ever since, and have worked frankly for a progression of smaller companies over. I went to work at Fidelity, and that was a small organization within a big company, and then I went to work at Simmons and Company, which was a small company, and I like being in the middle of something where your individual efforts can move the needle,
mm,
and and I think what we do at Pickering Energy, it is people oriented. It is we are trying to figure out investments. We're doing investment banking. We're doing consulting. We're doing research, all of which has an element of content and brain power, and not necessarily capital. And so, doing what you love, the oil and gas business, I kind of fell into it, and once you kind of spend the time on it, pivoting's hard.
mhm.
Plus, you have a network and relationship, and this is kind of a fun and important business. So
Yeah.
energy's always felt good, and then I like the element of betting on myself as an entrepreneur. And the other thing that you always wonder about, but it's definitely true, is that relationships that you build will travel. And so the people, I had a meeting in house today with a company where 22 years ago they went public. I was one of the analysts on the deal when they went public. Um, and we were laughing because we were talking about one of their assets that as an analyst I kept asking, when is it going to be delivered? And now the questions are like, how long how long till it's obsolete? The lifespan of this thing is crazy. So, um, so doing what you love, the power and value of relationships that move with you in your career over time is really important. And it certainly doesn't hurt to be associated with a business that, you know, everybody touches over time. So that's a pretty meandering answer, and I don't know if I actually answered your question, but
No,
uh,
that's good.
I like the process of doing something where your own efforts, you feel like you move the needle, and
Oh,
that's not for everybody, by the way.
yeah, it's not, but I can totally relate to that. I love the part you talked about where it's like this. I've heard other people like Naval talk about this, like kind of play long term games with long term relationships because it gets easier, and it's like there's a compound interest effect to that. It's like not only do you continue to gain knowledge in that space, you continue to have these relationships that then build, which then makes it easier in the future. If you've done good work for somebody, that there's the friction gets removed. If you have a high ethical standard, if you're somebody that's good to work with, there's just less and less friction and you gain more and more knowledge. And so therefore kind of start to create your own luck. In a way, things come to you is another way to put that. And then you talked about the, do what you love. And it's interesting because, Scott Galloway talks a lot about this, but he's like, don't follow your passion, but get good at something. And then that can become your passion. And it's like, people want to feel like they've done a good job and like their value add versus just trying to chase something. It's like, you liked it and you chased it. But, if you get good at something, which clearly you are in the energy space, and this is how I felt. It wasn't that I necessarily was like, oh, I'm going to be passionate about midstream and like gas and oil marketing and all this stuff. But like I did it and I got kind of good at it. And then I became passionate about it through finding something that I was good at. And then the last piece is, you said controlling your destiny a little bit and having, being able to put your finger on the scale and tip things in the balance towards, you. And to me, that's always been, I just feel better if I can have some of that, if I feel like I can put my energy into it and make a difference.
Absolutely, and you make a really good point. Um, it it is when I look at my career as a sell side analyst or as an investor, one of the things I love about that, I like this stock or I own this stock. If it goes up, you were right. If it goes
Mhm.
down, you were wrong. There's an answer, and if you can be right 60% of the time, that's really fulfilling, right? I mean, you can make a career off of that, and so for me anyway, the I kind of like to be out there where you can't hide. Your numbers are
Mm.
what your numbers are as an investment manager or as a stock picker and a sell side analyst. You got to buy on a stock and it goes down 50%. Guess what? You were bad at that stock pick. You better be better on the other ones, right?
Yeah. Yeah. That's good. Well, thank you for taking the time to do this. I know you're a busy guy, and I had you on the list for a while, and I'm like, Dan's busy. He's been on before, but I really appreciate it. I value your insights, and I know that the listeners will too. If people want to learn more about you or follow you, what are the easiest ways?
So check us out on our website, www.pickeringenergypartners.com. Now that I say that, it may be pickeringenergy.com. Google us. Our website, you can sign up. I write something every month. You can sign up for that. We're pretty accessible and want to be accessible, right? We're out there. We are a service business. We are trying to help companies raise money and sell their businesses, and we're trying to help guys, deploy capital. So, we're always interested in hearing from folks.
Awesome. Well, thanks, Dan. Thanks everybody for tuning in.
You bet. Thanks, Max.